you're buying it at two times, three times, four times the price of what had bought it at the start of last year, right? So now you're buying. I've experienced, going to the market and you're buying five pieces of tomatoes for 1,000 naira. This wasn't, the situation, some months back, but that's how things have literally deteriorated, and it's been an interplay of so many things: the insecurity I mentioned, the FX, the rising costs of the rising borrowing costs too is also a major problem, right? And so in all of this that I've mentioned, the question then becomes, what does this mean for you and I, right? The fact that you continue to experience FX volatility and insecurity, it means that inflation that I mentioned will probably still remain, higher than what it should be, or what it should have been, or what um, the government has as its own target, right? And lower. So if you're earning the same thing as what you earned last year in nominal terms, based on how inflation has moved, it means that you're basically earning lower, right? And that is a major issue. So if I had 10 naira that could buy me a pen sometime last year. This year, I probably, or it could buy me two pens last year. This year, it probably just, buy me one pen, and that becomes, that basically affects the standard of living for everyone, right? So it means that you have reduced standard of living. You also find that, the opportunities that were previously available um to job seekers and all is lesser, right? Because businesses would not be able to operate as much as they could do before, right? You have the cost of running day-to-day operation is higher. It means that I need to basically look for other ways to cut, cost and all of that. So all of those things, basically impact our day to day, and what the environment looks like. Now the next question becomes, with all of these things that we've said, what are the opportunities that we see in the market, right? The truth is, we believe that whatever you find yourself, the opportunities will always persist. Is for you to know where, or it will always exist. It's for you to know where to look at, right? And for us, we think that there's still opportunities within the naira denominated instruments, the short and the long term instruments. So we've gone from like about 10% or so to now you can get instruments that can give you as high as 20%, in the Nigerian market, right, for fixed income. And we think this is a great opportunity. The last time we had that was probably 2016, 2017, and you want to maximize this opportunity, because it's not something that would remain, forever, and this would be a good time. The other opportunity we see in the market will be the USD assets. We think that investment in USD asset will basically help you. You provide some sort of edge, right? Some edge for your portfolio against the naira volatility, and we think that it will be a good one, to basically have in your portfolio. This next slide basically elaborates on what I had mentioned in the previous slide, for you to see how, the rates I mentioned, how they've moved so far this year, to also see how inflation has, moved for each quarter, and how the reserves. So currently we have our reserves, as at time this report was written, reserves are dropped to as low as $33.6 billion dollars. We've lost about over 1 billion, in reserves from the start of this year up until now. So that's what the slide basically tells you. I'll just move quickly to the next slide, so as not to spend too much time or to overflog what had been mentioned before. This last slide basically speaks to the outlook on the things I've mentioned, right? So I've told you interest rates are high. I've told you inflation is high. I'm now going to address what we expect going forward for the second half as we cross into, this next half of the year. And the first thing will be interest rates. What do you think would happen, or what do we think will happen to interest rates for the second half? As it is, inflate because of the way inflation, has remained. We think that the CBN will continue to they want to leave rates, either at current level or maybe adjust it slightly higher, not significantly. But the point is, you have a relatively high interest rate environment relative to last year. And just because CBN will try to they will try to continue to combat inflation and then try to take up excess liquidity, and that means that to the extent that you would expect that to play out over for a large part of H2, it will be a good time to basically participate. So our expectation is that rates will remain relatively high if you compare it to last year, right? In terms of inflation, what do we think will play out? Like I mentioned, we are inflation is way above our target, but our expectation is as we go into the second half of the year, you might start to see a bit of base effects, kick in. So you might start to see a slowdown. And the point is, month-on-month inflation. You see that in month-on-month inflation is it's we've started seeing a gradual decline there, and it means that you will see that reflects in the year-on-year inflation as we approach the end of the year. Also, to the extent that the end of the year is also some sort of harvest season, so that should basically also be helpful in terms of where we see inflation, and basically optimistic there. For the FX rates, we are neutral, and that's because if you look at the past few weeks or months, you see that it's stabilized between 1.4 and 1.6, right? And CBN continues to make attempts, release policies to ensure that there's some measure of stability in the naira, right? So, for instance, we expect some inflow of about $2 billion from some of the multilateral agencies, just in a bid to also support the way the naira is so far. We think that that could, also help for near-term appreciation. However, in the longer term, until we fix some of the key problems that we're dealing with, infrastructure and the likes, we'll probably still, continue to experience all this one-off shocks, in the FX rate. For our growth forecast, we're very neutral also, and that's because of um, the dynamics of elevated borrowing cost. As much as it's good for the investor, is not exactly is not interesting, for the fiscal side of things, which is your government, right? It's higher borrowing cost for them, which means that recurrent expenditure is higher than what they are budgeted and the likes. And so, and this will basically also impact businesses. They will have to borrow higher than what they were borrowing before. You're also dealing with insecurity challenges. You're also still dealing with price levels, even if we think that they will moderate over the second half. The truth is, if you compare it to last year, it is still, relatively high. So that will basically affect what you would find in the non-oil and the oil sector, right? So we expect some sort of moderation for the growth forecast over H2. And so that's why we're neutral there. I would then hand over, that's the end of the macro segment. I would hand over to my colleague Kitom, who will then take us through the next part.
Thank you so much, Olamide. Thank you, thank you, thank you, thank you, thank you. Thank you for the insightful session. I took a few things down. I took a few things down. I've noted. I really want to appreciate that you addressed how high interest rates are, inflation, and how high borrowing cost is, and what we should expect in the second half of 2024. We'll be diving into the next session now, and the next session will be taken by the Chief Investment Officer at AXA Mansard Investments Limited, Taye Owonubi. He has over 10 years experience in investment management and securities trading, and I really cannot wait to hear what he has to say, because that is where the application comes in. Olamide has told us about what is going on in the market, what's going on in the economy. Taye is now going to be telling us how we can rise above it or adapt. Taye, over to you.
Thank you very much, Kito. And thank you to everyone for making time out. And thank you very much to Olamide as well. I think she was able to help, summarize some of the points. So I'm taking over here just to share a few things in and around. So we've heard what is going on. We've heard what the landscape looks like. I think the next question is, how do we distill this information and break it down into actionable steps or pragmatic, actions we can take to improve, our position from a financial, standpoint. So, Kiton, please, if you don't mind, if you can I just have a few slides that capture some of our thoughts on some of these points. So if we take directly from the last slide that my colleague just spoke about, I think I would summarize in three different points, in three applicative points. One is interest rates locally are very high, much higher than they've ever been in I would say most of my career, to be honest. And my career has been very short. I mean, DG's here. I'm sure DG has experienced even higher interest, but I haven't seen levels like this, in ages. In the same vein, we haven't seen inflation this high in quite some time. So when you begin to talk about real return, which is what you have when you back out inflation from what you earn on the nominal side, the conversation still remains that is negative. But if I summarize the 3 points from the information around the macro side, it would be one, for an investor or someone looking to maximize return on investment, one, interest rates quite high. That presents an attractive proposition for vehicles where you can achieve those high rates. Two, it's now more and more important or more pertinent to look at your portfolio from not just an asset class standpoint, but from a currency standpoint. What do I mean by that? For the longest period of time, we always build portfolios based on asset classes, and there are two main asset classes. There's fixed income and bond and equities. You can add a third one, which is alternative investments, but generally, traditionally, it's two asset classes. I think it's now time, especially for a Nigerian investor, to introduce something called FX in that asset class, and to have an idea or to have a target on how you want your investment or your portfolio split across currencies. That was the second point I took away. And then the third point is it's important to anchor objectives around time horizons. And what do I mean by that? And I'll take some of these points in subsequent slides. As we think about investing, most times we think about it in silos. What do I mean by that? Many of us here have different bank accounts. Some people use bank accounts for specific things. Many of us have different investment accounts. We also use those different investment accounts for specific things. We don't appreciate the fact that at the end of the day, when you look at your wholesome portfolio, you need to aggregate everything. And they'll tell you that money is fungible, but just naturally as a human being, you want to separate the money for rent from the one that you use on Friday or the one you use to buy a car. And when you separate them, you separate your investment actions on those accounts. So they may all be in the same vehicles or in the same investment options, or they may be in different ones. You may say, this money for rent, I want to put it in a more aggressive asset class so that it can grow quicker. This one that is for, let's call it school fees, I'll most likely put it in something more conservative. But what's more important is, when you aggregate those actions or those different vehicles, you have an aggregate allocation, and that aggregate allocation speaks to your aggregate overall objective. So the risk there is you may have investments in certain vehicles that are detrimental to others. And because you have looked at it in silo, you can't see how there's a better way to optimize it by aggregating your objectives together and then addressing that. That was the third point. I know it's a mouthful, but I think it was the third point that I took away from that. And what do we do with those three main points? Or what are we saying? What I'm saying is this: between now and the end of the year, we think this is the playbook to run. The first point is this: like we said, short interest rates locally are very high. There are numerous vehicles you can use to access those opportunities. I'll give you examples. Nigerian government treasury bills, fantastic. You can buy a 1-year treasury bill today at 20-25%, and it's risk-free. Risk-free meaning there's little or no possibility of a default or a credit, implication. Second point is you have fixed placement suites, and I have to stress this, quality, institutions, because in periods such as this, you also have all kinds of funny opportunities come up. So if you anchor your yardstick around just the yield, it's a bit myopic. You need to assess the opportunities based on both yield as well as how quality they are, their credit quality. So that's the second option. There are fixed placements with institutions, quality institutions, you can earn as high as 20% as well. I think the third point is You have money market funds. Money market funds are low risk, low investment vehicles. They allow you optimize return on your cash. You can earn extremely attractive yields there. Somewhere 18-20% is possible. They also provide the benefit of allowing you access liquidity whenever you want. So the point I'm making is, for people even at the lower end of scale, you are spoiled for choice. In this environment, you have so many opportunities, so many options. What are we saying you should do? We are saying, if you want to save, because there's an important distinction between saving and investment. And I think the point there is, before you start to invest, you need to save, to a certain amount or a threshold. But in the first layer, which is saving, don't save your money in the bank account, save your money in the money market fund. Easy peasy. So we are saying that sacrosanct, and you should do that. The next point is, when you want to take a step further, you need to start to assess options that give you longer tenor investments like treasury bills, at a much more attractive rate than the money market fund. That's step one. The second point, it ties into the initial point I made, the summary side about exchange rate. You need to begin to look at your portfolio from a currency standpoint. We've seen, if you take, a base case for the last few years, it's actually very, very, you would find that you would have generated negative returns if you had your investment solely in Naira. It's unfortunate, but, it's a fact. So how do you, forestall or prevent that or mitigate that? You need to begin to think about investing in foreign currency. What does that do? It protects you from a inflation standpoint. It also protects you from a foreign exchange standpoint. So you have to have, and I cannot stress one, you have to have, foreign currency in your portfolio. It's now non-negotiable. And I think that's the next point. And then the third point is time horizon. You need to ask yourself, this savings or this investment I'm doing, how long am I looking at it, for? Because that point is a very hefty point. It determines the type of solutions you can access. You don't want to match an investment to an opportunity. You don't want to invest in a long-term investment for an objective that is short-term. The issue is, you will need your money back before the investment matures, and you will then face price risk, meaning you can make a loss. So you need to match that time horizon. It's very important. If you have a long time horizon, you need to be looking at opportunities that are long-term in nature. So you just match it, simply. Now, if you move to the next side of the slide, you see that I have some points there around what our topics are, and I think I've touched on them. Sorry, okay, if you go back to that slide. Yes. So if you look at the box one, I'm talking about high quality commercial papers, fixed term placements, as well as treasury bills. Now, this is treasury bills in both. You can say I have USD there as well, because like I said, this is incredibly important to have an allocation to foreign currency. And we would think, we would recommend that for investors who are looking to just start, get their feet wet, this is the perfect place to start. Or mutual funds are the perfect place to start, but I would classify those as savings, not investments. When you are talking investments, box one is where you should start. And the opportunities now with very high quality banks, tier one banks, you can earn returns close to 20%. You have commercial paper opportunities as well, where you can earn returns well above 20%. You also have treasury bills, where depending on the tenor, you can earn very attractive returns as well. And the box just below is I'm talking about mutual funds. So we're talking about investments that are that allow you optimize your return but still provide liquidity, and that's really the primary objective of mutual funds. They decentralize investments, and lower the threshold so that everybody has access to it. So you can access the type of investment options that HNI or ultra HNI can access, depending on, no matter where you fall, on the scale. On the equity side, even though I wouldn't say we are very constructive on equities for the rest of this year, largely because interest rates are quite high. What usually happens to stocks generally is, in a high interest rate environment, they tend to, underperform. And that is a generalistic statement. Of course, there are some specific stocks who thrive, in a high interest rate environment. One of such would be banks, but there are other factors, around the banking sector that, that make us a bit, worried about that. But the point here is, On equities, if you don't want to take direct equity exposures, you can buy mutual funds. Equity mutual funds are your fantastic vehicles to achieve that. They give you access to stock. They also provide diversification because they have a laundry list of names in those, in the basket of investments they have, and they also have, access to quality, instruments. And then the last point is fixed income securities. So fixed income securities on the Naira side now, like I mentioned, very attractive. So we're having, 5-year paper, 10-year paper yielding 20%. If you buy, 20% securities, you're locked in at 20% for 5 years. I don't know that in any situation is not very attractive. And why do we say it's attractive? It's for two key reasons. One, those yields don't really happen every time. Two, why are those yields where they are today? Is because of some issues which we view as being transitory. If you recall, my colleague also said inflation is poised to decline going forward. What usually happens to long duration fixed income instruments is that when inflation comes down, they also come down as well because there's a relationship between inflation and themselves. If you expect inflation to come down, then you need to take a position ahead of that event happening. Fixed income securities at 20%, it provides you an opportunity to earn those yields for a long period of time. So even when interest rates comes down, you're still locking, at those yields. So I think if I was to summarize the point from my colleague, it will be those first 3 points, as well as how you can then access those options is the 4 points in the boxes. Kito, if you can move to the next slide. The next few slides I have is I think maybe a bit related to some of the points I mentioned before about profiling. And I learned something today. And it ties back to the initial point I said. When we think about investor profiles for clients, we're very used to, well, most people are used to these options. You're either conservative or moderate, or you're aggressive. Of course, they are in between. So you can't look at it as a destination, but as a journey. There are some people who fall in between conservative and moderate. There are also some people who fall between moderate and aggressive. There's some people that you can't even classify them. They exhibit, multiple profiles. But another layer to that is to think about it this way. Instead of profiling an individual, the primary principle is that you profile objectives. When you profile objectives, it gives you the opportunity to allocate profiles based on the characteristics of behavior of that objective. I'll give you an example. An individual can have 3 objectives. Objective 1, I want to save money so that I can buy a new car. I want to save money so I can buy a house. Objective 2, and I also save money so that I can go to school. One key important information when you've been able to establish your objective is to ask yourself, what is the time horizon? Because the time horizon is a very hefty factor in determining where you fall under the risk spectrum. What do I mean by that? For someone who wants to buy a house, I would imagine the time horizon for that to be very long. However, if it's someone that wants to pay rent is paid annually. You can see that the time horizon for that person is short. So you can have 2 different individuals. One wants to buy a house, one wants to rent a house. Those are 2 objectives. You can have one individual having those 2 objectives. I want to keep renting a house for the next 5 years while saving so that I can buy a house. So 2 very distinct objectives. In those objectives, the objective for rent is conservative. Why is it conservative? The time horizon is quite low, 1 year. The objective for buying a house will be less conservative. I don't want to use the word aggressive because it can also be moderate. And why? Because of the time horizon. And this is a very simplistic example. But the point I'm trying to make here is this. That same one objective is exhibiting 2 profiles. The individual has 2 different objectives, and on the basis of that has 2 different profiles. So you can't call him a conservative person or an aggressive person. He's a little bit of both. Or better put, his objectives are conservative and aggressive. And for me, it's a very subtle distinction, but it's an important thing because as we think about building portfolios or making investments, we need to start, the most important thing is to profile it. You have to profile it because profiling it will determine the type of investments that you make. And those investments you make will determine whether or not you're able to achieve that objective. I think most of the other points here are quite important as well, or sacrosanct, but I think for me, making that distinction is very important. We need to have very clear objective sets. We need to have defined definition of those objectives from a from a profile standpoint, and those profiles will then determine the type of investments we make under those objectives. If you don't mind, if you can move the slide, just yes. In all what we've said, what are the opportunities? I try to capture the opportunities in two large buckets. There is the non-mutual fund opportunities, which is spoken about. So if you look at outside your mutual fund buckets, you have you can invest in bonds, both local bonds and foreign bonds. You can invest in equities. You can also invest in foreign currency, equities and bonds, and even lower or money market instruments. And those are accessible or available in all currencies. It can be USD, it can be pounds, it can be even euros. You can find opportunities such as that. I think. Yeah, and of course, it would be unfair if we did not display, our own propositions in this, presentation. So we've introduced, I think this slide and the next slide, just to touch a bit more on mutual funds, how they operate, what are the options that are available to you, and how you can key into those. Mutual funds are the perfect way to start your investing or your savings journey, if I can use that word. They provide you access to attractive propositions where you can optimize your funds in your account with little or no penalties, little or no complexities, and it allows you experience the savings process. So for people who don't save or aren't used to it or are just beginners, you could access mutual funds. They give you, the length and breadth of how you want to, start your investing journey. They give you the opportunity to experience how or what the outcomes are like, and what investing or savings is like. So, I think that's my last slide. Yes, fantastic. Thank you very much, everyone, for your time. I hope I've been able to pass across particular message, and thank you again.
Yes,
Thanks.
thank you. Thank you so much, Tai. Thank you. So we are now in the question and answer sessions, and I believe that some questions are already being answered. I've seen some questions being asked on the chat, so I think I'll just take a few of them while our representatives address the ones that were unable to take due to time limits. So this question from Adeoyade says, "What is the minimum amount to start the foreign currency investment?" I think so. If you're speaking to the dollar bond fund, it is just $2,000 to start the foreign currency investments. You can just reach out to us on clientservices@axamansard.com via email to start your investment. The next question says that what is the minimum amount to invest with bonds and euro bonds? Tai, do you want to take that?
Yes, thank you very much, Peter. So, the threshold for investing, or let me make distinction this way. You have opportunities that are standalone and direct, for example, euro bonds and bonds, where you have higher thresholds. Sometimes, not all the time, sometimes. What mutual funds do is they lower those thresholds and give investors access to their same opportunities. So to answer your question directly, the minimum entry point for euro bonds is $50,000. For naira bonds, I think it's 50 million and 1,000. However, you have mutual funds who invest in these same securities, but have entry levels or entry threshold of 1,000 naira, 2,000 naira. And as Ketan has said, for the dollar bond fund, $2,000. Now, what does the dollar bond fund do? The dollar bond funds aggregates the funds which you invest, in it with, and then invest in those same euro bonds. So in essence, you're investing in euro bonds, but just with a lower threshold. So let me reiterate. Entry level for euro bonds, $50,000. However, you have a dollar bond fund where you can access, those same euro bonds with less than that amount, $2,000. Entry for naira bond funds, for naira bonds is 50 million and 1,000 naira. However, you have bond funds where you can access, those securities at 2,000 naira, 1,000 naira. Thank you.
Okay, thank you so much, Tai. So next question says, what is the minimum amount to invest with bonds. Oh no, I think that's the question I just read. Miss Patience says that she's been trying to invest in foreign currency investments on our platform. So she wants to know, are there immediate plans to make it accessible via the app? Taye or Lamide, anyone can take the question.
Yes, thank you very much, Kito. Yes, there are. But first, the website, and of course, the app, to allow, investors access, those opportunities. Currently, what we have there is more skewed towards local investments, but I think in a very short period of time, we would have we would be able to open up access to foreign currency investments under our platform, strategy. Under the platform strategy now, we also do have, opportunities, but in Naira. And that would then be expanded as well. So the answer to your question is yes, that would be available in a very short period of time.
Okay, thank you. So Tai, just now that we have you here, let's just take the next question. It says, what will be the best investment with a greater return to venture in? And I think this is a retail investor asking for someone with 1 million naira, what is the best investment that will achieve a greater return?
Yes, thank you, Kito. So I'll say two options. One is mutual funds. With mutual funds, you can earn something around 20% now, or even higher. I would recommend you build your funds to in that vehicle. So you save using a mutual fund vehicle, and when you have, when your funds have grown, you can then pivot and use those funds to access government treasury bills because they're the lowest risk investment opportunity. However, currently in the market, the highest yielding security or the highest yielding opportunity would be money market instruments issued by commercial institutions. I have to caveat that because if you recall in my presentation, I made a comment about not just anchoring expectations around yield. What we like to look at is what you call risk-adjusted return. What does that mean? That means any opportunity you access, it comes with some corresponding risk. So you can't really compare nominal yields on a case by case. An example of that is I can't say institution A is giving me 30% and institution B is giving me 25%. So the 30% must be the best option. No, we need to go a bit further and assess what is the level of risk institution A is giving, is taking to deliver that 30% to me, and you compare it to B. More often than not, when you do the comparison, you'll find out that the lower return is a better one. Because for you to deliver 30%, you must be taking on an insurmountable amount of risk. So, but I digress. I think your point was the highest yielding opportunity. Currently, we have Nigerian government treasury bills delivering somewhere around 25, 26%. And that is for a tenure of 1 year. We also have commercial institutions that are delivering returns between 22 and 24%. That ranges from a tenure of 90 days to 1 year. I think in the Naira space, those are the options available. Thank you.
Thank you so much, Tai. Sorry, someone wants a clarification. Says, sorry, did you say 1,000 naira and 50 million naira for the Indian bonds?
So I mean, just for a bit more color on that, you can access NGM bonds via two channels. One at the primary auction, which is conducted every month. The minimum entry for that is 50 million and 1,000. However, at AXA Mansard, we provide opportunities for individuals with amount. What we do is aggregate. Via our platform strategy, we're able to do this. And one of our tenets is especially investments that are not exactly available to investors in the lower category. We try to decentralize those. For instance, not every institution will offer you Eurobond at 50,000. In fact, in some cases, we go as low as $20,000. And how we're able to achieve that is we have, Marialo, a large pool of clients who are looking to assess the same opportunities, and we match individuals with similar profiles, and we provide the opportunities to them at no cost. So For your question directly, the minimum entry level for the Naira bond auction or Naira bond is 50 million and 1,000 as prescribed by DMO. That's the Debt Management Office. However, we can provide, the option or the access for less. I think the second point is for Euro bonds, minimum is 50,000. However, we can also provide, access at a lesser amount. Thank you.
Thank you, Tai. So the next question says, how can we invest in a semiconductor ETF?
Okay. Yes. So you can do that through us as well. Again, I know I keep saying platform strategy, but yeah, as part of our platform strategy, we provide access to opportunities, and the idea is we see ourselves as a one-stop shop for investors to access financial options. We don't want clients to come to us and then have to open numerous accounts with numerous houses. So what we do is we aggregate. So through us, you can access pretty much any other opportunity. So if you had funds with us and you saw opportunity somewhere else and it was something you're interested in, you can instruct us to do that investment. The relevant information, we would achieve that. So you don't need to go there to open a different account. With your account with us, think of it as a global account and you can access those options. So if you want to access ETFs, we have a partner that provides us access to global equities. You can do that through us. You just complete the onboarding process, and then we would provide all the other, fund your account, and you give an instruction, and it's done, and the report will then be provided, to you. I hope I've been able to answer that question. Thank
I
you.
hope so. And if you don't think you have enough clarity, please leave a follow-up question. Our representative will speak more on that. The next question says, how short is short? She wants to know the duration, like how short is short duration, and that how long is long, basically.
Okay, thank you very much, Kito. I'm hoping that maybe one of the questions would also be for Olamide. Looks like anyway. So that's a very good question, actually. And the answer is, and I know it's not an answer you like, it's relative. So in a different context, 1 year can be short, and in another context, 3 years can be short. In Nigeria, on the Nigerian context, however, I would say that you should view 1 year as being short, and anything beyond 1 year as being long. In fact, I would add 1 year to be short and sort of like 3 to 5 years medium, and then anything above 5 years long term. And it's also an important question because depending on that horizon, you can distill that information to know the type of investments to make, basically. But I would say 1 year short, 3 to 5 year medium, anything above 5 years long. Thank you.
I think the last question that we'll take for now is this. And if you have additional questions, please send them to client services at axamansard.com. So we will take the next question now. And it says that, are the foreign euro bonds subject to loss? Like she said, the euro bonds, are they subject to losses? Yes, are they subject to losses?
Okay. I can't mute my mic.
Yes. So Eurobonds are securities that are issued by either sovereigns or corporates. They are usually dollar denominated. No, they are foreign currency denominated. I think the principle for Eurobonds is you need to be issuing at a currency different from your local currency. So for instance, if a US entity issued a bond, but in euros, it will be termed the euro. When I say euros, okay, let's say yen, it will be termed, a euro bond, basically. And your question is it subject to loss or what we refer to as price risk? The answer is yes. And what does that mean? It means the price at which you buy the security today, over the period or the life of the investment, that price may go lower or higher than that price. That's the essence of it. However, the positive part about Eurobonds is when you think about price risk, if your intention is to hold that investment till maturity, there's zero price risk. Yeah, little or no price risk, because what it means is that when you buy Eurobond, normally the issue are usually redeemed as what we call par. Is this relevant? A point is, if your intention is to hold your security to maturity, the impact on price risk is very minimal. I think that's the point. However, to answer your question directly, yes, Eurobonds will have price risk, or you have a chance of incurring a loss, but only if you sell before maturity.
Okay, I know I said last question, but I've seen this question twice, and people want to know if they can convert their money from the money market funds to dollars and to invest in USD securities.
Well, I think I'll answer that question in two ways. One is, of course, we still operate in Nigeria, a Nigerian entity. I think there are houses who have licenses to do this. And what we will typically inform clients is to leverage those houses. We don't have that license to operate, at that level. We do have partners sometimes who we partner with, and then provide these opportunities. But that's on a case by case basis. I know I didn't necessarily answer your question directly, but yeah, I think in some way, shape, or form, I was able to respond. Thank you.
I think to some extent you're able to answer that question. Thank you so much, Tai. And thank you everyone for contributing through your comments and your questions. I repeat, please, if you have any questions that you feel were not answered, please send us an email at clientservices@axamansard.com. We'll have a representative answer any and every question that you have. If you would like to also jump on a call, you can specify that in your email and we will reach out to you. So I would be handing over to Deji to take on the closing remarks.
Thank you, Kiton. Thanks, Tai Lamide. Special thanks to everyone for joining us today. I hope it's been valuable. I know this is just the start of the conversation, so please, send us an email. I think it's clientservices@axamansard.com. There's a lot going on, like I said. The environment is shifting. We're moving from high inflation, high interest rates to lower, and this is a key time to take those decisions. But I know a lot of you on the call will need a lot of guidance with this. So leverage the support we can provide to you. Please reach out to us on all our channels. And I certainly look forward to having another session of this nature with you. I wish you all a great day. Thank you all. And special thanks to all the organizers. Have a great day. Thank you.
Thank you so much, Deji. Thank you so much, everyone. Have a fantastic weekend ahead. Bye.
if we take directly from the last slide that my colleague just spoke about, I think I would summarize, in three, different points, in three, applicative points. One is interest rates locally are very high, much higher than they've ever been in I would say most of my career, to be honest. And my career has been very short. I mean, the G's here. I'm sure these has experienced even higher interest, but I haven't seen levels like this, in ages. In the same vein, we haven't seen inflation this high in quite some time. So when you begin to talk about real return, which is what you have when you back out inflation from what you earn on the nominal side, the conversation still remains that is negative. But if I summarize the 3 points from the information around the macro side, it would be one, for an investor or someone looking to maximize return on investment, one, interest rates quite high. That presents an attractive proposition for vehicles where you can achieve those high rates.
the fact that you continue to experience FX volatility and insecurity, it means that inflation that I mentioned will probably still remain, higher than what it should be, or what it should have been, or what um, the government has as its own target, right? And lower. So if you're earning the same thing as what you earned last year in nominal terms, based on how inflation has moved, it means that you're basically earning lower, right? And that is a major issue. So if I had 10 naira that could buy me a pen sometime last year. This year, I probably, or it could buy me 2 pens last year. This year, it probably just, buy me 1 pen, and that becomes, that basically affects the standard of living for everyone, right? So it means that you have reduced standard of living.